We are going to cover some of the details of bond investing strategies in this module, and we will make use of a PIMCO reading that's part of the this week. So I would suggest you read that. And this module has been, or that reading has been, suggested for the previous week as well. Couple reasons to hold bond in the individual portfolio. And again, what you would expect from bonds is lower returns than on equity investments, but lower risk. Although those relationships can turn and have turned in the past, in recent years actually many bond funds have done better than many stock investments. But a couple reasons to hold bonds. One is for diversification. Bonds provide diversification to a portfolio, which we've seen has been important. And secondly, for capital preservation and income. Bonds are much steadier income sources. They have steady payments. They have scheduled payments, and more often than not, those payments happen on those dates. It's unlike equity investments where there is no obligation to pay dividends. Some companies do pay dividends regularly, but there is no obligation for them to pay dividends. So one of the reasons why we hold bonds in a individual's portfolio is again for diversification, capital preservation, and income as a second reason. An individual has two ways of holding bonds themselves or through mutual funds, and you could hold them also as ETFs. But the decision on bonds differs than that on stocks. There's some reasons why you would want to hold bonds themselves. If you hold the bonds themselves, you can control when the individual, takes the capital gain, or if you take the capital gain. If an individual buys a bond and it has, based on that, it has a yield to maturity that can be calculated, that bond will give that yield to maturity if it's held to maturity and that bond does not go into default. So you buy a bond, you will get that yield, assuming that you get all the payments, which is, depending on what you invest in, is a pretty good assumption. Mutual funds will not necessarily do that because the traders themselves are the mutual fund managers themselves are managing the fund and maybe selling and buying bonds, or they will be doing that, and hence will be incurring capital gains and capital losses. And every day the NAV of a mutual fund is created or calculated, and there will be capital gains and capital losses. Mutual funds have two primarily advantages. One is diversification, and that's particularly relevant for non-treasuries or the risky assets. If you want to reduce your risk, again, diversify, and one good way of doing that is holding a mutual fund. And mutual funds are very easy for investing and getting in and out of. They're easy form of investing. Market timing, arguably, and I would argue, is more of a issue with bonds than for stocks. You do know that if we're moving into an increasing interest rate or yield environment, mutual funds and bonds in general will suffer capital losses, and vice versa. So the percent that an individual holds in bond may be influenced whether we're in a rising or falling interest rate market. Also, the sectors that an individual may invest in will be influenced by what they believe that sector risk is. And there are bonds that hold not only in corporate bonds, but very specific corporate bonds of specific type. So if a sector is risky and an individual wants to stay out of that sector, it's possible to do that. So in bond investing, there is the possibility of market timing. All of this to say is, why hold bonds? Bonds themselves are mutual funds, and market timing. Holding bonds is a bit different than holding equity investments. While we do believe these markets are efficient, and there's good reason to believe that, there's still reasons why you would want to hold one bond versus the other just from a market timing standpoint.